Yes, we can.
Okay, so good evening. So in our last class, we started looking at IS 19 on employee benefit. And I told you in the last class that basically what you need to know in this standard is that you need to understand how to account for the benefits or the consideration that an employer gives to its employee in return for the services the employee has rendered to the employer. However, we quickly went on to the categories of these employee benefits we can have, from the short-term benefits to the post-employment benefits. Then we said we also have the other long-term benefits. And finally, there is the termination benefits. We said that our focus is going to be on the short-term benefits and also on the post-employment benefits. So I will discuss briefly today on other long-term benefits as well as this termination benefits. So last week, I remember clearly that we looked at the short-term employee benefits that basically considers the benefits that an employer pays to its employee for working for within a short period of time, or an employee benefit that is payable within 1 year. So that's why they call it short-term employee benefit. It's payable within 1 year. So, and that will usually be the monthly wages and salary and all our allowances that we get for working with an organization. Then we also looked at how we recognize and how we measure this type of benefits last week. So basically, when you have short-term employment benefits, it's just for you to recognize it as staff costs in your books. And if it has not been paid, that will be a liability as well in the books of the employer. Then we looked at short-term paid absences, where we considered cumulative paid absences and the non-cumulating paid absences. And paid absences are basically the money your employer will pay you even when you are absent. And basically that would be something like leave allowance or maybe sick leave allowance. So popularly is the leave allowance that you might be absent and your employer will still pay you. So the way we said that is accounted for, it now depends on the policy that the employer adopts. If it is a policy whereby if you don't go on leave, you will not get the money. And that is it. You will lose the money. We say that is a non-cumulating paid absences. To account for that is very straightforward. If you don't go on leave, which means that you will not get the money, that means it will not even show in our books at all, because we don't have any liability, neither do we have any expense, since you did not go on leave. However, if the policy is such that even if you don't take the leave, you can still carry it forward to next year, then that becomes an accumulating paid absences. Therefore, at the end of the year, the entity has to estimate how much they will have to pay next year when you eventually take the leave. And we looked at some examples to address that also last week. Look at some corrections here. And finally, we considered profit sharing and bonuses, which is also a type of short-term employee benefit. And this can only be recognized when the entity is sure that they will actually pay profit share. I mean, they must have declared profits and the management must have announced that, okay, we want to share profit to our employee. Then at that point, the employer has an obligation in their books and a corresponding staff cost at the year end. We looked at all that last week. Then we went on to the post-employment benefit. For the post-employment benefit, we started saying that majorly these are benefits that are paid to an employee or payable to an employee at completion of employment, usually at retirement. And a typical example of that would be your pension that you get. Not only that, we could also have things like medical care. There are some employer that will say when you retire, we will take care of your medical care. There are some that will say we'll take care of if you have children still at school, we'll take care of their school fees and other benefits like that. So, but popularly is the pension. And you see, because this has to do with a benefit that will arise much later in the future. So the way it works is that employer usually have a plan or a post-employment benefit scheme. We mentioned it last week. And we said these plans, IAS 19 mentioned that there are two. It categorized them into two. We had defined contribution plan, and also there is the defined benefits plan. For the defined contribution plan, we said the obligation that the employer has is to make regular contribution on behalf of the employee, just like what we have in Nigeria right now. Where at the end of every month, your employer will take 10% of your basic housing and transport. They will take that and go and keep it for you and call it pension. And in addition to that, the employer also will help you add 8% to it, making 18% total. They will contribute it. So they keep doing that every month. So when you retire, you know the money is going to be with your PFA, and you can go and claim it from your PFA. If your PFA, for whatever reason, says that they don't have the money anymore, that they have invested it in such a way that they lost it, you know, that loss become your own loss as an employee. Is not attributable to the employer. You cannot come back to your employer that, the pension you were paying, you were removing on my behalf, they have lost it. Oh, it's not possible. Because, and that's a typical way a defined contribution plan works. That's why this standard called it defined contribution. As far as the employer is concerned, the only obligation the employer has is just to make regular contribution. Beyond that, it doesn't have any further obligation. So the person exposed to risk under a defined contribution plan is either the employee or the scheme, or maybe the PFA in which the money is being contributed to. Either of them are the people that are faced with investment risk in case they lose the money. But today, as far as IAS 19 is concerned, what we are accounting for is from the standpoint of the employer. Therefore, accounting for a defined contribution plan is relatively easy because all the employer has to account for every month is just the contribution he is making, which simply means that at the end of every month, we're going to debit staff costs and you're going to credit bank with the amount of pension that is paid. However, if they have not paid it, we will still go ahead and debit staff costs. Some people specifically debit pension costs, depending, it's just a nomenclature, but ultimately, it's just staff cost. Then if you have not paid it, then you'll probably be crediting an accrual or a liability. However, if it's possible that some people can overpay, then that becomes a prepayment. And I can remember vividly last week that we looked at a question, a past question, an ICANN past question addressing defined contribution plan. And I hope you revised it. We looked at that last week. Then we went on to define benefits plan. You see, when it can be established that the obligation of the employer is beyond the contribution alone, is beyond what they are paying to the PFA. If the obligation is beyond that, then automatically it becomes a defined benefit plan. If the employer is also exposed to certain risk, typically an investment risk, then it becomes a defined benefit plan in the sense that, yes, they will still make contribution, but if the contribution they are making, if it's not sufficient to pay the pension of the employee when they retire, if the employee can come back to the employer and say that the money you contributed is not enough, I will need more, right? Then that means it is a defined benefit plan. And why would the employee be able to come back? The reason is that the employer has actually keyed into making a promise. He has made a promise to the employee that he's going to give him a defined benefit. He's going to give him certain amount of benefit. So it was specific with the benefits. And that is why for a defined benefit plan, the employer has an obligation for life because he has to ensure that he meets up with that benefit. He has to ensure that he meets up and he pays up that benefit. So for that reason, in order to account for this, it comes with series of complexity. Number one is that how do you even establish the amount of benefits you want to pay? Number two is that how do you then go ahead to capture your obligation, like yearly? So it comes with a lot of its own complexity. And we accountants, we are not trained to be valuers. We are not supposed to be valuing liability and stuff like that. Ours is just to recognize and measure transactions in the books. So whenever an entity has a defined benefit plan, you'll find out that they will usually engage the service of an actuary who are trained professionals to help you determine values like this. So the actuary would give you certain number of figures that you would need to now eventually incorporate into your books. And I can remember we discussed those items last week. And what the actuary is going to provide to you, I told you that the first thing the actuary will give you is the regular contribution that the employer is supposed to make. The regular contribution that the employer is supposed to make. And you, accountant, as soon as they give you that, all you just need to do is just to recognize that in your books. And the way you go about it is that the contribution you are going to debit it to a plan asset. And of course, you're expected to be paying it. So you're supposed to credit your bank. Money leaves your account. And since it's going to be a monthly thing, if you don't pay it at the end of the month, you have to accrue for it. So it becomes a liability. However, I told you that usually these post-employment benefits, employers would have create a plan. And that is why this contribution is now being contributed to a plan asset. And when I say plan asset, it's going to be a situation whereby the employer would either be investing in real estate, or is going to be investing in stocks, or is going to be investing in some insurance policies where you can be contributing certain amount of money every month, or maybe into a mutual fund. That's what I mean by plan asset. It's not like they are keeping cash somewhere. That will not be wise. It's better to invest it. And that is a key distinguishing factor between defined benefit plan and a defined contribution plan. Because A defined benefit plan, you find out that it's the employer that manages that money, that contribution themselves. They would either say, okay, we want to be contributing this money or keeping this money in an insurance policies or maybe in real estate, or they are managing it. Unlike the one that is obtainable in Nigeria majorly, where employer just pay to your PFA. So it's not your employer that is managing the money, it's the PFA. But because of the typical nature of a defined benefit plan, whereby the employer has keyed himself into specifying certain amount of benefit to you at retirement. So he has to ensure that it meets up. So they always manage that money themselves. So they create a plan asset, usually which will either be an insurance policies, a real estate, a mutual fund, or stocks, where they will be contributing the money to. So you as the accountant, all you just need to do is that you get the actuarial report. Inside there, you will see this contribution. Just debit plan asset and credit bank. Then the actuary will also give you in his report something called current service cost. And this current service cost is the amount of benefits that the employee has created for himself for working for you for 1 year. And it is this current service cost that would ultimately build up the post-employment obligation. Because as the employee is working every year, is creating that current service cost. It's like it's now due to a benefit, a post-employment benefit. Because this post-employment benefit is not like it's automatic anyway. The employee must work. So as he's working, there is a benefit attributable to him, which is not payable now, remember. It's payable when he retires. So they call that current service costs. For working this year, this is what you are due to. Abi? But as far as the employer is concerned, it's an expense to the employer for that year. So it debits that current service cost to P&L, and the corresponding credit goes to a present value of defined benefit obligation, right? Present value of defined benefit obligation. That goes to show that this current service cost it will have been a discounted amount. It will have been a discounted amount. And again, you see, this actuarial report is provided annually. It's just like, and usually it's going to be the auditor. If you are the auditor of a company and you get to the company and you discover based on the nature of their plan, you see that the employer has keyed himself into promising certain amount of benefit to the employee. You know that this is a defined benefit plan. The next thing you should request for is an actuarial report. If they don't have one, you have to engage one, because it is not your job as an accountant to do this, to get these figures. No, they provide it to you. Your own is just to account for these figures. That is our own concentration. So it's a report that is provided annually. Sometimes some people don't even do it every year, depending. So it could be every 2 years, but annually is the best practice. So for this current service cost, for the employer, it's an expense. It's just like, okay, now I'm owing this guy a certain amount in the future for the fact that he has worked for this year. So when they give you current service cost, just remember to put it in the P&L, and the other leg go to a present value of defined benefit obligation. That goes to show that this current service cost is a discounted amount. It's like they will have discounted it somewhere. So it takes it to PV of defined benefit obligation. You see, this PV of defined benefit obligation is a liability account that will get carried forward year on year, year on year, year on year, in such a way that after 5 years, it is this account you can use to know how much you are owing to all your employees. That, okay, for the fact that they have worked for me till this date, I am owing them this amount, which is payable when they retire. When they retire. Okay? And don't forget, you also will have been planning for that, which will have been contributing to a plan asset. So you just need to be comparing your how much is in my plan asset, how much am I owing, how much is in my plan asset, how much am I owing. You would see how to match it very soon. Now, another one or item that the actuary is going to provide to us is a past service cost. Past service cost. And this past service cost is conditional, is not really automatic. It doesn't, the actuary does not come with it automatically. Why? Because what it means is it usually occur when there is a change in this obligation, in this defined benefit obligation. And what can make the defined benefit obligation change is either there is an amendment or there is a curtailment. So what is an amendment? An amendment is when an employer introduces a new plan. For example, they say that, okay, we are now going to introduce a Medicare care plan. So maybe the company is doing well. So they say that, okay, so in addition to this contribution I'm making for you guys for your retirement, I want to introduce medical care plan for you guys in such a way that when you retire, you don't have to pay for medical bills. Your medical care plan would take care of that. So which is good. But for the employer, it will increase its costs. It will increase their cost. Their obligation would expand, would be bigger because they have to be contributing more. Okay. So you see that change in obligation as a result of this amendment, which is an introduction of a new plan, that change is a past service cost. That change in obligation, because you are introducing a new plan, that's an amendment. And it can also be a curtailment. And curtailment is the opposite of amendment, whereby there is a closure of part or an entire plan, saying we're not doing again. I'm not contributing again. And this will usually occur when the entity is not doing so well and they have to liquidate. I mean, no more business. So there would be a change in the plan. That is curtailment. Anyways, that change in the plan as a result of a curtailment is also past service cost. The difference is that if it is an amendment, it's going to increase the obligation. If it is a curtailment, it's going to be reducing the obligation. And that would dictate how we account for it. For you, the accountant, when you see a past service cost, you recognize it to your P&L. It's an expense, it's an additional expense if it is an amendment for that particular year. And of course, you credit the obligation because it's going to increase the obligation in case of an amendment. But in case of a curtailment, which is we are not doing again, they are shutting down, that will reduce the obligation. And you just credit your P&L with the past service cost. Another thing the actuary is going to provide to us is benefit. Benefit. And this would arise when an employee retires. That is when benefits can arise, when the employee retire. So all happens is that when employee retire, I'm already prepared because I've been contributing already. I just need to go and take money for my plan asset. Not necessarily money. I'm going to settle the employee through my plan asset. That's why we are crediting the plan asset, because your plan asset is going to reduce. And of course, it will raise some part of your liability as well, because I'm not owing him again. So I debit my liability as well. So it nails off. That's how benefits are treated based on what the actuary is going to give to you. Another one is settlement. And settlement will usually arise when there is a curtailment. Whenever an employer says that I want to close a plan, that means they're ready to settle, because you will have been contributing to the date when you say you want to close. Then whatever you are owing or whatever obligation till that date, you need to settle people. Okay. So that means you are going to take some from your plan assets, then it will raise an equivalent obligation. However, in most cases, we find out that it won't be the same. It could be in such a way that the obligation they owe is 50 million, and they agreed um, to settle with 45 million, meaning the amount they have to take from their fair value from the plan asset. So we see that as the settlement price. So if you owe 50 million, that's your obligation to the date you said you want to curtail or close down, and you are settling with 45 million. That is a gain. That is a gain. So settlement would, you have to take some amount from the obligation, take some amount from the plan asset. If there are differences, it's either going to result in a gain on settlement or in a loss on settlement. So like in this example you are seeing in front of you right now, this is a gain because I have an obligation of 50. I owe 50 naira, and they agreed a settlement price of 45 naira. That's a gain. I've gained 5 naira. I'm not going to settle the remaining 5 naira. So this gain, you recognize it into your POL. Furthermore, I gave some notes on projected unit credit method, which is the approach recommended by IAS 19 to be used by an actuary in getting all of those figures I've just discussed. And from the name projected unit credit method, it works in such a way that every year the employee works, the employee will have created a unit of benefit for himself in the future. That's how they actually thinks. That is how they build up that current service cost. And that's how they eventually build up the obligation. That's the brain behind most of these figures they give to you. And I've told you that because this has relates to benefit payable in the future, it has to do with a lot of discounting to get what is the value now today. And it also has to do with a lot of assumptions, which the standard called actuarial assumptions and stuff like that. But you can read through this, gain one or two, but we are not really particular about that. The examiner will not ask you to explain projected unit credit method and all the work that the actuary does. No, they won't. They would never ask you that. They have never asked it. So you need to pay more attention to knowing how to account for all of these figures the actuary has in his reports, which I've mentioned above. I'll still mention a few more later. However, for us quickly, based on all the figures I've explained above, then what goes into your statement of financial position and what also goes into your statement of profit or loss? In your statement of financial position, we would recognize a singular amount known as either a deficit or a surplus, which we determine by comparing the present value of the defined benefit obligation with the fair value of the plan assets. Remember, I mentioned this obligation, which is usually built up through that current service cost. That obligation, at the end of every year, we are going to match it against the plan assets. We don't recognize them separately in the balance sheet. We usually recognize only the nets. So if your obligation at the end of the year, if it is higher than your assets, that is not good for you. Then the standard calls that a deficit or a net defined benefit obligation. A net defined benefit obligation or a deficit. However, if your plan asset happens to be higher than the obligation, it goes to show that you have sufficient contributions, you have sufficient money to take care of your obligation. That's what it shows. So that would be like a surplus, or the standard calls it a net defined benefits asset or a surplus. However, however, because this will now be recognized as an asset, we need to subject it to a recoverability test. And what do I mean by that? When you say that you have contributed more than your obligation, when you say that your plan asset is higher than your obligation, it means that you have contributed much more than what you are owing. Then the benefit to you as an entity right now, because if you have to recognize something as an asset, it means that it's going to generate benefit to you for it to be an asset. So that's why we are subjecting it to a recoverability test. Now, what can you actually recover from this surplus? And it's two things. It's either it's going to result in a refund, or they will reduce your future contribution. It's either a refund or a reduction in future contribution. So we need to subject it to this amount. You will see how this works when we solve examples on this particular scenario. So majorly, that is the only item that goes into the statement of financial position. We'll probably have shown this in our workings, comparing the benefit obligation with the fair value of the plan asset. Is that net figure that goes into our statement of financial position. Depending, it could be a net defined benefit obligation or deficit. It could be a net defined benefit asset or surplus. In the statement of profit or loss, your current service costs will show that. Your past service costs will show that. Your gain or loss on settlement will show that. And also is a net interest on defined benefit obligation. And why this net interest is coming up is that whenever we discount, whenever we recognize a present value in the current period, as we move through time, there will be an unwinding of discount. And this unwinding of discount is just accounting for time value of money. We usually recognize it through finance cost or interest, either interest income or interest expense. You'll see how this works. I will show you a very simple way to do that. And also, in your statement of other comprehensive income, and if you remember vividly, what goes into this statement majorly are remeasurements or changes in the value of assets or liabilities. So what we're going to find there are items like actuarial losses or gains. I will show you how to do this with figures to make it easier for you. We would have a return on plan assets, and we'll have changes in the effect of asset ceiling. All these we're going to look at with figures just to make it easy for us. Then going forward, let's look at this question. Because I can remember we did not look at any question last week. Let's look at this question together. Before I look at questions, are you guys following me, or I hope you're not sleeping? You have any question? Now, this question says that at 1st January 2002, the fair value of the assets of a defined benefit plan were valued at 1.1 million, and the present value of the defined benefit obligation was 1,250,000. That's at the beginning. Okay. And I said on 31st December 2002, the plan received a contribution from the employer of 490,000. and paid out 490,000. And I'll say the current service cost for the year was 360,000, and the discount rate of 6% is to be applied to the net liability. After these transactions, the fair value of the plan assets as at 31st December 2002 was 5 million. The present value of the defined benefit obligation was 1,553,600. We are required to calculate the gains or losses on remeasurement through OCI and the return on plan assets and illustrate how this pension plan will be treated in the statement of profit or loss and other comprehensive income, and also in the statement of financial position. Okay, like I've told you, they will give you all the figures you need, everything. You just need to master how to deal with them. So this question will teach us how to do that. So usually, before you prepare your statements, we'll start with our workings. And these workings would help us determine the PV of defined benefit obligation, the plan assets. And I told you earlier that the singular figure that actually goes to the statement of financial position is the net of these two. That's why I have on the third column a net defined benefit assets or obligation, which I'll show you in a jiffy. So let's pick the figures one by one. They said at the beginning of the year, they gave us the fair value of the assets to be 1.1 million and the PV of the obligation to be 1,250. And that is why this represented the balance brought forward. For the obligation was 1.250 and for the plan asset is 1.1 million. Going forward is, remember I told you about interests because of discounting or present value. We need to unwind. So it's always advisable that you get the net interest immediately. Immediately after you have recognized or shown your opening figures, you must immediately recognize the interest so that you won't forget. And this interest is just calculated by applying 6% on this opening value. If you apply 6% on 1,250, that gives me the 75,000. And also, if I apply 6% on 1.1 million, that gives me 66,000. And this is the 6% I'm using, the discount rate. And they already told us that it will be applied on the net asset or liability. So usually what we recognize in the books for this interest is the net. So because the liability is higher than the assets and the difference is 9 million or 9,000 here, I'll just put it in brackets so that they will know that it will be an expense since the liability, right? This is like a net interest. This is like a finance cost. The one relating to the asset is like a finance income. So cost is higher than the income. So that's like a net cost. Okay. So I'm done with that first one. Now, they also told us that the plan received a contribution of 490,000. So we make regular contribution of 490,000. And contribution are made directly into the plan assets. That's where we contribute. That's where we contribute to. And that is why this is an addition here under my plan asset. Because I contributed to my plan asset. Then the benefits. Yeah. Back to the question. They told us that they paid out a benefit of 190,000. They paid out a benefit of 190,000. So benefits would erase my obligation because I will have paid it out for my plan asset. So I'm removing it from my plan asset. I am also removing it from my obligation. It nails off. That's benefits. I'm paying out benefits. Okay, a DPO is defined benefit obligation. Defined benefit obligation. Then going forward, in the next paragraph, they told us that the current service cost for the year was 360,000. And this current service cost, if you remember, I told you this is what built up the obligation, the defined benefit obligation. So, and that is why it's an addition here. It's an addition under my defined benefit obligation. And they also now give me at the end, the fair value of the plan assets at the end of the year was 1.5 million. And the obligation was 1,553,000. So I will show you how to do this now. But first, since I've recognized all the items that affected the PV of the defined benefit obligation and the plan assets, let me get what the carrying amount would be, which is my book value. If when I cumulated all of this under this DBO, I got 1,495,000. When I cumulated all the figures under the plan asset, I got 1,466,000. That's my book value.
Sorry, sir, I
That
have a question, please.
okay, please ask.
Sir, why did we deduct the benefits from the plan assets? The 196,000.
Okay, so that I can help you better. So do you think we should add it?
Yes, I was thinking we'll add it since we are also lessening it from the obligation. So I was thinking it will increase the plan assets.
Okay, why will you increase the plan assets when you're actually paying it from it? Is a benefit. And I told you that is when somebody retires that you will pay benefits, and that benefit will be taken out from your plan assets. So should I increase it or reduce it? It will reduce it. To reduce it because you are taking it from it. It's just like you are contributing money and you now need it. You're not going to take it from it. It will reduce the money you have now. This is like the money the company has been contributing. Now somebody retire, they want to pay the person. They take it out from it. And the equivalent obligation to erase because now we are not owing the person again. Okay. So like I was saying, now, after recognizing all these figures, this is what the book value of the defined benefit obligation should be. This is what the book value of the plan asset should be. But the actuary also now gave us the fair value as given in the question. The actuary said the fair value of the plan asset should be 1.5 million. And he also said the fair value of the obligation should be 1.2. We will need to compare the two. So for the obligation, the actuary said it should be 1,553,000. However, from all the items we have accumulated together in our books, we got 1,495,000. So invariably, the actuary is telling us that what our obligation actually is 1.5, which is higher than our book value. That is not good for us. That is not good for us because we said our obligation based on all these items you recorded under obligation, it should be 1.495. But the actuary came up with 1.5 million. So it's like we have an additional obligation. So we see this as remeasurement. So we call it an actuarial loss because we have more obligation because the way I would need you to remember it to know whether that is a loss, just know that is this favorable to the entity or not? And from what I'm looking at, it's not favorable to. So because we in our mind, based on our book, based on what we have recorded, we are having 1.4 million, 1,495. The actuary came and said, no, you owe more than that, oh, it is 1.5. So just you as an accountant, You don't need to argue. Just book the difference, because this is what will now go into your books. You replace this with this one that you have. So that increase in obligation as a result of this remeasurement by the actuary is a loss. It's a loss. So this loss will go to OCI. Again, for the plan asset, we got 1.4 million on 466. The actuary said, no, our asset is more than this. Our asset is actually 1.5 million. That is good for us. It's like we are making a gain. But now, because that has to do with assets, they call that return on plan asset. Since it is coming up as a result of a measurement as well, it will also go to OCI. So we have solved the first part of this question, asking us to calculate gain or losses on remeasurement through OCI and return on plan asset. So we have an actuarial gain here, actuarial loss, and here we have a return on plan asset. They also asked us to prepare statements. So in the statement of profit or loss, what goes to your P&L from this, one is the net interest. And I told you it's the net that goes to P&L. And that's why this one is coming as an expense. That's why I put it in jacket. Secondly, is your current service cost. And that's why this is coming here also as an expense. Current service cost. In the other comprehensive income, you have those changes in value as a result of remeasurement. Actuarial loss first, which is 58,600. That's why I put it in jacket to show that it is a loss. And we have return on plan asset, which is this return on plan asset here. I put it as positive figure to show that it is an income. And that's what goes into the statement of, into your statement of other comprehensive income. In my statement of financial position, like I told you, what goes there is the net. And since the actuary has given us a fair value, we're going to work with that. The obligation was 1.5 million, 1,553,600, which is higher than my plan asset of 1.5 million by a figure of 53,600. Since my obligation is higher than my asset, so I am owing more than what I contributed so far. That is a deficit, which we would also call a net defined benefit obligation. And that is why I am putting it under non-current liabilities, coming in as a deficit or a net defined benefit obligation in the amount of 53,600. And that is the end of this question. Do you have any question before I ask you my question, to be sure that you understand what I'm saying? Any questions?
Good evening, sir.
Hi, Omotayo.
I'm fine, sir. Okay, I want to understand this workings better. For this current service cost, does it mean what the employer is expected to pay for the year?
So again, if that will make you understand it, that is what it looks like. In fact, that is what it is. In fact, the way the actuary will have done it is that he will have gotten this current service cost by doing the present value of this contribution. You know,
Okay.
this contribution is like, okay, I'm contributing 490 for your future. For your future. But the worth of it today, the worth today is this current service cost.
Okay.
Like they will have gotten the present value of that future contributions. That's a smart question. Yeah, I like that.
Okay, so my second question now is for the actuarial. He's going to give us the figure for the defined benefit obligation. Is it the one that will give us the figure?
Yes.
What about the plan assets? Who is giving us the fair value of the plan assets? Is it also the actuarial?
Yes, it's the actuary that will give us. He's
So
one that
it's
will
giving
go
us two figures.
if he's giving us all the figures.
Okay.
Yes, all the figures. All you just need to do as an accountant is these things we have just done. For you to know that, okay, when it gives you the opening, or from your books last year, Seb, you would have the opening. So you just ensure that you do your net interest. You ensure that you add your contribution to the plan asset, because you should know it's going to the plan asset. You should, if there is benefits, know that it's going to erase some obligation and you're taking out the benefit from your plan assets. And your current service cost, it's what build up your obligation, and that's it. And you get your book value, which you have to compare with the fair value the actuary will have even given you also at the end of the year, to know whether you're having an actuarial loss or gain in the case of obligation, and a return of plan asset in the case of a plan asset. And that's all you have to do as an accountant. Nice one, Omotayo. Yeah, I need more questions from you guys. Okay, since you are not asking any question, right? Since you are not asking any question, so let me ask you a question. So now, in my P&L, I only recognize current service costs and net interest. And in OCI, I recognize actuarial loss and return of plan asset. And in my statement of financial position, I recognize the nets of the plan asset and the obligation. So where are these ones going to? Contribution and benefits, because I didn't put them in any of the statements. Where are they going to? Since you have refused to ask, I want to believe it's because you know. So let me ask you, where are they going to? Or where did they go to? Let's start with the contribution first. I'm waiting for your responses quick, because you did not ask.
Hello, sir.
Hi, Omotayo, here.
For the contribution should go to POL, since it's going to be an expense to the company.
But we did not put it in POL now. We did not put it in POL. So that means it should not go to POL. In fact, based on the question
Right?
you asked previously, what actually replaced this contribution in P&L is the current service cost, because that is one that's the expense for the company now.
Okay, for
So
that contribution, I thought it's also the same thing as the current service cost, which is a cost to the company.
exactly. So this one has gone to POL, but the
Okay,
contribution is
okay.
another figure on its own. So where will it go? It has to go somewhere.
So, can I have it?
Yes, please.
So I think the contribution will still remain in the plant assets account until it's paid out. Then there'll be a deduction.
Fantastic. Yeah, that's correct. Yes, that's more like it. And why she's correct is that if you remember, when you make contribution, okay, the two legs are you are contributing into the plan assets and you are taking money from your accounts. So plan assets and bank. Okay. Unlike current service cost, for example, now, the first leg goes to obligation, is an obligation, and the second leg is an expense, P&L. And that is why this current service cost is going to P&L, because of that second leg that goes to as an expense, P&L. But contribution, first leg is in assets, second leg is reduction in your bank, because you're actually paying money. The same thing applies to the benefits. The first leg is you are taking money out from your plan asset. And the second leg is reducing your obligation. So it has nothing to do with P&L. It only deals with the plan assets and the obligation. And that is why we didn't find them directly in our statements, because these two were impacting your assets and liabilities. They had nothing to do with P&L, like directly, unlike this interest and current service cost. Okay, so let's go to another question, which is more advanced than this one. Question 2. Please, I need you to pay attention very well to this. So he said that for the sake of simplicity and clarity, all transactions are assumed to occur at the year end. So the following data applies to the post-employment defined benefit compensation scheme of BCD Co. It gave us a discount rate of 10%, give us PV of obligation, which is the PV of the defined benefit obligation that I call DBO. At the start of 2002, they said it's 1 million. They gave us market value of the plan asset at the start of 2002. They said that one too is 1 million. And they also said that the following figures are relevant. They gave us for 3 years, 2002, 2003, 2004. They gave us current service costs. They gave us benefit paid out. They gave us contribution paid. And the guy also gave us present value of obligation at the year end. These are the fair values for each year. And also give us fair value of plan asset for each year also. So all these figures would have been given to us by an actuary, which we are going to find in an actuarial report. So he now gave us some additional information. He said at the end of 2003, a division of the company was sold. As a result of this, a large number of employees of that division opted to transfer their accumulated pension entitlement to their new employer. And assets with a fair value of 48,000 were transferred to the other company's plan. And the actuary has calculated that the reduction in BCD's defined benefit liability is 50,000. The year-end valuation in the table above were carried out before this transfer was recorded. Okay, before I go to additional information too, I want us to dissect this additional information. One, let's understand what it's speaking to. I can see here that a division of the company was sold. So as a result of that, the employee were requesting for their money, of course. So they now said the plan assets of 48,000 was transferred from the company. The actuary said that the obligation that will reduce is 50,000. And they said these amounts has not been deducted from these fair values given. But I'm less concerned about this for now. I'm more concerned about this 48 and 50. But first, what's this speaking to? What's the term I used when I say that when a company shuts down, or they say we are not doing again? What's that term? I'm asking, it's a question.
Is it not the curtailment? Curtailment.
Yeah, that's correct. That's correct. Fantastic. That's a curtailment. Correct. So what do we do with these 48 and 50? What do we do with this 48,050 now? What do we do with the 48,050? The question. So let me tell you. Okay. I hope I won't have to tell you again when you see it somewhere again, or in an assignment, or in your test when I give you a test. So this is a settlement. I mentioned settlement, that whenever there is a curtailment, you find out that there will be settlement. So, and settlement simply means that we are going to take some of our assets and use it to net off that obligation. So this 48,000, the company is transferring. We are simply going to remove it from our plan assets. And the actuary has said that with this 48,000, you said our obligation has reduced by 50. So we are going to remove this 50 also from our obligation. However, you will find out that the asset was lower than the obligation by 2,000. What do we call that 2,000? It's a question. What do we call this 2,000?
Is it loss on settlement, Sabi?
Okay, yes, at least you have an idea, but this is not a loss now.
So it's net obligation.
No, far from it. It has nothing to do with that. So it's either a gain or a loss on settlement. It's either a gain or a loss on settlement, but this particular one is a gain on settlement because we were owing 50 and they said that we are settling with 48. You owe somebody 50 naira and you settled out with 48. That means you are gaining 2 naira. The person is letting go of 2 naira. That's a gain for you. And that gain on settlements, we are going to book that also in the statement of profit or loss as a gain on settlement. And that is it for this note one. The only thing is just that you just have to remember that they said the year-end valuation in the table above were carried out before this transfer was recorded. So meaning that for this 2003, these assets that they transferred, remember to remove it from these assets because they said they have not removed it. And this obligation, remember to remove it from this obligation. I will remove it. I will show you so that we will do what the question wants us to do. Okay, that is that. Now, pay attention to this question two, this note two, because you will tell me what this is speaking to also. This said that at the end of 2004, a decision was taken to make a one-off additional payment to former employees currently receiving pension from the plan. Listen to this very well. I'm reading this sentence again. It said at the end of 2004, a decision was taken to make a one-off additional payment to former employees currently receiving pension from the plan. They want to make one-off additional payment. Now let's know what that payment is meant for. So let's go ahead. They said this was announced to former employees before the year end. This payment was not allowed for in the original terms of the scheme. The actual valuation of the obligation in table above includes the additional liability of 40,000 relating to these additional payments. Okay, so they didn't really say what it relates to, but what I can see is that the company is saying, I'm going to give you more money when you retire. I'm going to give you more money when you retire. It's making additional promises equivalent to 40,000. So the question is, what is this 40,000? What is it speaking to? How do we deal with it? What is it called? What is it called? Who can tell me?
Sir, I think it's an amendment.
Amendments.
Amendments. Fantastic. And that is correct. That is correct. So if this 40,000 is an amendment, now this 40,000, is it now going to go to P&L, or how do we deal with amendment? How do we deal with amendment? Because yes, you have gotten it. You understand that it's an amendment. That's correct. But you as the accountant now, they are giving you 40,000 that this is an amendment though. So where do you put it in your books?
We will debit P&L with
That's
the
correct.
amount.
That's correct. So where do you credit?
Plan assets.
No, obligation.
Obligations.
Yeah, is like it's an additional payment. It's a one-off, so it's like you have additional obligation. You have an additional obligation. That was why they are saying that the actuarial valuation of the obligation in table includes it already. They have already added it to your obligation. So that's fantastic. And this is what I called changes in your obligation as a result of an amendment. And you just simply call it past service cost in your P&L. That is what I call past service cost. Okay, fantastic. So we have dissected these two, and that's what makes this question more complex than the first one. So what we are left to do is just the same thing like we have done before. So you have to start with your workings before you go to your statement, because you need to get your book value of the present value of defined benefit obligation and also of the plan assets. Then don't forget to have the nets, because it's the nets that goes to your statement of financial position as a single one-off item. So in 2002, the opening figure given in the question was 1 million, 1 million. This 1 million here that they gave us, opening for obligation, opening for asset. So in 2002, don't forget, start with the net interest. They gave us a discount rate of 10%. That's why I have net interest. 10% of 1 million, 100,000. 10% of 1 million, 100,000. This is blank because the net is going to be zero. The net is going to be zero. Then in 2002, they gave me a current service cost of 140. So I have my current service cost. That has to be added to your PV of defined benefit obligation, 140. Then they gave me my benefit paid out. Benefit paid out, 120. So my benefit paid out, don't forget, I'm going to take the benefit from my assets. That's why I'm removing it from my assets. And it's going to erase an equivalent obligation because I won't be owing that portion anymore. So I have to remove it. And they also gave us contribution in the question. Where is it? Yeah, contribution of 110. So I have my contribution paid, should be paid into my plan asset. I'll add it. So I'm done with everything. So I get my book value. When I accumulate 1,000, 100, 140, 120, I get 120. Accumulating this gives me 1090. Then the guy also gave me the fair value of the obligation and fair value of the assets. For the obligation, the actuary gave me 1.2 million, meaning that in my books, I'm saying my obligation is 1.1. The actuary is saying, based on what I'm looking at, the fair value is 1.2. That is bad for me. I'm owing more. That's why I called it an actuarial loss. Again, the actuary gave me a fair value for the plan asset of 1,250. But in my books, based on this cumulation, I have 1090. This is good. And that's why I have a positive return on plan asset, which I will take to OCI. And that is all for 2002. So the mistake I think we might make in the exam is that you might forget to put this. Most students usually forget this net interest because they will just give you a discount rate in the question. They won't tell you what you should do with it. You have to remember to use it to calculate your net interest. And you just need to know current service cost that is going to increase your obligation. You need to remember that benefit paid out is going to reduce your obligation and your assets. And you need to remember that contribution paid should be added to your plan assets. You will always find these three in the exam, always. So at least just know how to deal with current service costs that will be added to your obligation, benefits that will be taken out from your obligation and assets, and contribution that will be added to your assets. I mean, that is a sure mark for you in the exam. Okay. Now, in 2003, my brought forward will now be the closing of 2002, which is the fair value. Obligation, 1.2. Assets, 1,250. Then, in order not to forget, I'll quickly do my net interest, which is 10% of the opening values. So I have 120, 10% of 1,250, I have 125. My asset is higher than my obligation. Yeah, by 5, positive 5. Then in the question, they gave me a current service cost of 150. I add it to my obligation. They give me a benefit paid of 140. I take it out from the obligation and the assets. And there's a contribution paid of 120, which I will go and add to my asset. And don't forget the analysis we did for this one, this note 1. I told you that you should remove this 48 from your assets, remove this from your liability, and recognize the balance of 2 as a gain on settlement, which is what I did here. I removed the 2, the 50 for my obligation, remove the 48 from my assets, and there's a 2 which I'm going to transfer to my P&L as a gain on settlement. When I cumulated all these figures for liability, my book value is 1,250. However, the actuary said, no, it should not be 1,250. It should be 1,650. So before I put the 1,650, they told me that they have not removed this 50. You know, I've removed it in determining my book value. So as to be comparing like with like, I need to remove that 50 from this 160 first, so that I'm left with 1,600, which is still higher than my book value. So it's still a loss because I have an additional obligation of 320. So I have an actual loss of 320. Again, cumulating this asset gives me 1,307. The actuary gave me 150 as his own fair value. I need to remove that settlement price so that I'm left with 1,402, which is still higher than this my book value, which is good for me because my asset is higher. I have a return on plan asset. And that's that. So you can just simply ignore all these ones that I have here, these nets. So I will only need this 198 because I will go and that's the figure I will put in my balance sheet. The same thing as this 50. That's the figure I will put in my balance sheet. Then finally in 2004, my closing figure becomes opening here. My closing figure becomes opening here. Then not to forget, I quickly do my opening. That's my interest. 10% on 16 gives me 160. 10% on 1,402 give me 140.2. In this case, the obligation is higher than the assets. So I have a net interest expense. That's why it's in jacket. Then the question gave me a current service cost of 150, which will always be added to the obligation. And give me a benefit paid of 150. which will be removed from the obligation as well as the plan asset. They also gave me a contribution paid of 120, which I'm going to add to my plan asset. And don't forget the analysis we do for the note 2, or we did for the note 2, where we describe this 40,000 as an amendment or a past service cost, which is an increase in our obligation. So you can either call it an amendment here, or a past service cost. I called it a past service cost and I added it to my obligation. When I accumulate these entire figures under obligation, this 16 plus 160 and all of that, I have my book value to be 18. But the actuary gave me 17 as my obligation, which is higher than my book value. Sorry, it's lower than my book value, which is good for me. I'm saying my obligation is 18. The actuary said that you are not owing up to that. What you are owing is 17. So I quickly put this one as a gain in my OCI. Again, my plan assets, I got 1512. The actuary said that no, it's higher. It's 1610. Fine, good for me. I put it as the return on plan asset of 90. So in my statement of profit or loss for the intervening periods, I have my net interest for my schedule in 2002 is 0. 2003 is a positive 5. 2004 is a negative 20. Comes in as an expense. Then my current service cost, 2002 is 140. 2003 is 150. 2004 is another 150. Then my gain on settlement, I have 2 here. Remember this 2 here. The gain on settlement. Then don't forget the past service cost of 40. It also comes to P&L. It happened in year 4. Then in my OCI, in each period, is either I have a gain positive or a loss negative. 2002, I have a natural loss of 80 and a natural loss of 320, but an actual gain 100 in 2004. The return on plan assets, it was positive all through in each year. If you have a situation where the fair value of the plan asset is lower than your book value, that means these figures will be negative in OCI here. And in my statement of financial position, if you look at year 2, what you need is the net of the 2. And is this fair value you work with? 50, my assets was higher than the obligation. So I'll have a net defined benefit asset or a surplus, which I will recognize under non-current assets. And that is why in my statement of financial position, under non-current assets, I have a surplus or a net defined benefit asset of 50. In 2003, still working with this fair value, the obligation here was higher than the assets by 198. So that means I will have a net defined benefit obligation or a deficit of 198, which I'm going to show under my non-current liabilities. And that's why it's coming under non-current liabilities, deficit or net defined benefit obligation of 198. And in 2004, still working with fair value, the obligation is still higher than the asset by 90. That will be a net defined benefit obligation or a deficit, still under my non-current liabilities. And that's why I have that 90 under here. And that is the end of this question. So it's not far or substantially different from the previous one, just that this one has 3 years and the closing of the previous year becomes opening of the next year. And this additional information, your ability to decipher it, will see that it's actually very straightforward, nothing out of the ordinary, straightforward. Any question before I move to the final question on IAS 19? Then we'll round up on IAS 19 with that question. Any questions? Okay. So on a final note, is something I've spoken about before. In this, now we are putting a term to it. I'm going to call it asset ceiling test. Earlier on today, I told you that whenever you want to have, whenever you have a surplus here, like in this case, we had a surplus of 50. I told you earlier that we need to subject it to a recoverability test. That can we actually recover it? Because it's an asset, it should give us future economic benefits. And in this case, the benefits we can get from this scenario is either we are getting a refund, because for you to have a surplus or a net defined benefit assets, for your plan asset to be higher than your defined benefit obligation is because you have contributed so much money. In fact, you have over contributed. So the benefits you can get is either they reduce your future contribution so that the plan asset and obligation can match in the future. So they reduce your obligation, or they refund you. They refund you. So either of them. So all I just want to look at here is a scenario where those figures are given. So you just actually have to do a comparison between the figures you will have gotten here by comparing the plan asset against your obligation that would have given you maybe a surplus, and comparing it with either the refund or reduction in future contribution. So you would see the examiner giving you that, okay, the refund you can get is 30. Like in this case now, let's say you got 50. The examiner now said the refund you can get is 30. So that means subjecting this 50 to a recoverability test means that we can only recover 30. So that means instead of recording 50 here, we have to reduce it to 30. That is also a remeasurement. That change, that reduction of 20, we call it changes in the effect of asset ceiling. And since it is a remeasurement, or since it is a change in the value of an asset, it's definitely going to be recognized in the OCI, which is your other comprehensive income. And you see this picture I've painted, subjecting a surplus or a net defined benefit asset to a recoverability test is what the standard called asset ceiling test. By comparing the surplus with an asset ceiling, which is speaking to the savings you would actually make, either in terms of refunds or reduction in future contribution. And that is it. That is all we want to look at in asset ceiling. So nothing really different from what we have been looking at. Let's look at this question to close out IAS 19. So this question is talking about this guy. They called him Apple Co. He manages a defined benefit scheme for its employees. And I said at 1st January 2008, the fair value of the pension scheme assets was 137 million and the obligation was 122 million. They said the asset ceiling has been calculated to be 4 million. Okay. They're giving us the asset ceiling at the beginning. Okay, maybe probably like the asset ceiling test they must have done last year. So this is the brought forward. We'll see the effects of that. And they also gave us a discount rate of 4%. And they also gave us some additional details. They said the contribution they made is 7 million, benefit 6 million, current service cost 5 million. They now said at December 31st, 2008, the asset ceiling has been calculated at 11 million. No, now they are giving us asset ceiling again, meaning the actual savings. that is made to be 11 million, either from refund or reduction in future contribution. They said it's 11 million. We would see how that will affect our calculation. Then after during the year, there was a scheme curtailment resulting in a gain on settlement of 3 million. And for you to have a gain, it means that your obligation will have been higher than your asset by 3 million when there was settlement. You know, for whenever there is curtailment, there will be settlement. Now, this question is giving us a gain directly. They didn't give us, okay, this is the amount of obligation you need to raise. This is the amount, this is the settlement price. They didn't give us that. They just gave you the settlement straight. That is the gain on settlement. But you need to understand that for us to have a gain on settlement of 3 million, that means the obligation must be higher than the asset by 3 million. That's why we made a gain, because we settled for less. Note that, because I will need it. Finally, they said immediately after the scheme curtailment, they actually valued the scheme asset at 148 million and the scheme liabilities at 136 million. So they are giving us the value at the end of the year. Now, there are some notes here, which I will just explain with these workings here, so that to be clear. So similar to the table I've been doing, in my workings, I have this is my plan assets, this is my DBO, present value of defined benefit obligation, and this is the net. Let me leave this one for now. I'll speak to it very soon. So the figures at the beginning, for the plan assets, they gave me 137 million. For the liability, they gave me 122 million. Now, the only reason I'm getting these nets of 15 million is because this question gave me an asset ceiling at the beginning of 4 million. Meaning that what we'll have recognized as, because the asset was higher than the liability, they will have had a surplus. It should have been this amount they will recognize, it will have been the asset ceiling. Because that means since they have asset ceiling, they will have restricted to that recoverability test. That is the actual amount they can actually recover is 4 million. So it's always the lower. Okay. So that's why the only reason I'm having this ceiling adjustment here is just to show that I will reduce this 15 by 11. So this 11 is just 15 minus 4. Just to show you that, okay, there was a reduction in this 15 by 11 to 4. And I was given this 4 in the question. It's just to show you that there will be a reduction by 11 to 4. However, immediately you get your opening figures, you need to always quickly do your net interest so that you won't forget, which is 4% of this. Give me this. 4% of this gives me this. All I need is the net of 0.6. However, since what I need is net, and I have already explained that it's not this 15 that goes into our books as net, it's this 4. That means the net interest that will go into our books will actually be 4% of this 4, which is 0.6. Again, that means we are reducing from 0.6 to 0.16. So there's a reduction by 0.44. So this is the amount that would actually go to my P&L. And since the asset is higher than the obligation, then that means it's going to be a positive. It's going to be like an income. And of course, for you to even be talking about an asset ceiling, it means the plan asset was higher than the obligation. So this 16 is going to come into my P&L as an income, which is 4% of 4 million. Going forward, the question gave me the contribution, and contribution is always adding to my assets. Okay. And they also gave me a benefit, which will be removed from my asset and my obligation. And they also gave me a current service cost, which will be added to my obligation. And there was a curtailment and settlement because we had a gain on settlement. That means my obligation was higher by 3. So we'll have a gain. I just to demonstrate, just to show that the obligation, that's why this one I'm putting nothing here, because the question just gave me a gain. And for me to have a gain of 3, the obligation must have been higher by 3. So that's why I put 0 here, nothing, and here 3. So we have a gain of 3. So when I accumulate all these figures, I have 143.48. But on the basis of what they actually gave me as fair value at the end, is saying my asset should be 148. And again, when I accumulated all these liabilities, it gave me 122.88. But the actuary is saying, no, it should be 136. I actually work with the obligation. I work with the fair value. So if I do, my asset now is higher than my obligation by 12. So ordinarily, this should be a surplus or a net defined benefit asset. However, the question told me that the asset ceiling is 11. He said the asset ceiling is 11. Since the asset ceiling is 11, that means this is what I will recognize in my books as surplus, not this anymore. Because the question already gave me, he has already subjected this surplus to a recoverability test or to an asset ceiling test. And don't forget, this can only happen when you have a surplus. When you have a surplus, meaning when your asset is higher than your obligation. So when we compared it, there was a ceiling adjustment of 1 to reduce this to 11 million. So this is what goes to my non assets as assets at surplus. Why this one will represent changes in the effect of asset ceiling that will go to my OCI. Now, since I'm not working with this 12 anymore, so I can't be comparing this fair value against these figures. I can't be comparing this fair value. What I'll be working with, I'm not working with this 12. What I'm working with is this 11. So what I'll be adjusting or comparing this 11 with to get my actual gain or losses or my return on plan asset, as the case may be, is this. I'll be comparing this book value, because this is my book value. This, when I compared it with this, the asset was also higher here, 20. And if I consider this ceiling adjustments here, this 11 here and this 0.44 here, I have this. It was removing it from this 20.6, brings it down to 9.16. And since this, my book value now is saying my surplus is 9.16, but asset ceiling is saying, no, it is more than that. So that is a gain. So that's like a return on plan asset of the difference. Based on the explanation I have here, that's like 1.84, which will simply go to my, like an actual gain or a return on plan asset that goes to OCI. So intentionally, I did not put the statement here because I need you to show the statement for me, which is straightforward. So in my statement of financial position, this would be a surplus. Then the difference between this and this would be an actual gain in OCI. Then net interest of 0.16 will go to P&L. Current service cost of 5 will go to P&L. Gain on settlement will go to P&L. And that is it for this question. So the only additional thing this question brings you is asset ceiling. And see, I kind of never asked any question on asset ceiling. So this is me going extreme for you guys. It's me going extreme. ICANN exams are usually simple to a large extent. They don't usually come up with questions like as deep as this. But I can assure you that if you put in the effort to understand this, you are covered for your exam. I'm 100% telling you this. However, I'm done with my class for today, right? Because other long-term benefits, I can never ask it and they won't ask it. And majorly is because this other long-term benefit is talking about, is similar to post-employment because it's talking about benefits in the future, but it is easier. Everything I've mentioned under post-employment benefit is the same thing as other long-term benefit. The difference is that this one doesn't have any remeasurement. They will not have any remeasurement to OCI. That's the only difference. And the last one, which is termination benefit also. Termination benefit is just when an employee says he wants to leave, like I'm going, like before retirement. So that one is straightforward. If they want to give him something, they will give him. If it's the employee that will have to drop something in lieu of notice, that means there will be a reduction in staff cost. But if it's the employer that says, go, go, some companies would give them some money that take for the fact that we are terminating your appointment, take this payoff. So termination benefit is straightforward in the sense that it's recognized when it happens. So if you are paying them off, credit bank, debit staff costs. So it's straightforward. However, what you find in the exam is either a defined contribution plan or a defined benefit plan for post-employment benefits. And if you understand what I've taught you today, you will never have issue with any question ICANN wants to ask. And if you remember when we solved the last past question ICANN asked, I solved it last week with you guys. And I know that, let me not assume, but you guys are not showing as if you have really revised these things. I solved this question. This was the last question ICANN asked, and it was on defined contribution plan. And it's very straightforward, very straightforward. And it was for 10 marks. And this is last two diets. So it's really nothing serious. So I'm giving you assignments, even though I know that all the assignments I've given this class, nobody does it. You guys don't do assignments, and it's not good for you. I will still give you. Hopefully you will change and start doing assignments. So I'm going to give you this question. Go and look at it. It's really nothing serious if you understand all I've been explaining. I know the solution is here. So I would advise you to attempt it before looking into the solution. That would go a long way to help you. So I'm going to close this class on these notes. Next week, Tuesday, I'm going to be starting and finishing financial instruments. It's going to be a long class. Yeah, Omotayo.
Can we have these notes? I don't have it.
Okay. I guess you should check your email because I've shared it with you.
Okay. Then,
Yeah.
sir, the recordings, you've not been sharing it all.
Oh, okay.
I think you only shared twice. I only
Yeah,
have 2 recordings.
I stopped sharing it via email. Just go to that YouTube link. It's all there. I stopped
Okay, there
sharing.
is a YouTube. Is it for this class or for past classes? The YouTube link.
Yeah, for past classes. This class too will be uploaded there. All our classes, all the classes are on the YouTube link.
I don't have the link, because the
Well,
ones I have are the ones you share with on my email.
oh, okay. That means I have to share it with you then. Just chat me up. I'll share it with you.
Okay, sir.
Yeah. All right, guys. Thank you very much. See you next week. Bye-bye.